Returns from most asset classes were positive over the quarter. Developed market equities eked out a small positive return, and Japan made up some lost ground after a disappointing start to the year in the prior periods. Investment grade corporates and sovereigns added about 1 to 2% in local terms, and global listed property a little over 3%. But the pace of gains has clearly slowed from the first half of the year, when the effects of falling rates and a more accommodative policy lifted risk assets together more strongly. There were also areas of weakness during the quarter, notably in emerging market equities, which fell around 2% in local currency terms. Emerging market bonds fared better, but local currency bonds underperformed as the currency softened. Sterling had another tough quarter, falling over 3% against the dollar, but it did manage to gain a little ground on the euro. And the continuing Brexit negotiations and our exit from the EU will undoubtedly continue to push sterling around. Market performance has been mixed, and August was a challenging month, but September saw a recovery, and this pattern has repeated several times now this year, and it's likely to continue in some shape or form. What is driving this market volatility? Well, it's the weakening market data, evidence of a global manufacturing recession and uncertainty surrounding the US-China trade war, and whether this will ultimately push the global economy into recession. The jury's out on that right now, but the policy response has been pretty swift, and in our view, the response supports risk assets in the near term. The European Central Bank reduced its deposit rate to -0.5% and resumed quantitative easing at a run rate of 20 billion euros per month. The Federal Reserve cut rates twice, but it indicated it doesn't expect further cuts either this year or next. But that puts it at odds with the market, which is already pricing in at least 2 cuts by the end of the year, and an additional cut next year. In fact, we've just learned overnight that the Fed will restart their Treasury purchase program to alleviate a cash squeeze in the dollar repo market. And I think whilst this masks some underlying issues, it should be viewed positively. There have been no quick wins on the trade front. Both the US and China need a deal to be done. Trump needs it because an election's in sight next year, and Xi needs a deal because of the marginal contribution to Chinese growth, which is declining. But both leaders like to be seen as tough, and hence concessions won't be easily given. And this is not solely about trade, on which we would hope to see progress before the end of the calendar year, but forced technology transfer, theft of intellectual property, and cybersecurity, for which there are no quick fixes, irrespective of who ultimately takes charge of the White House. Another major area of geopolitical uncertainty is the Middle East, following the drone attacks on Saudi oil production facilities. Given the rapid relative decline in the importance of oil in the global economy, the risks associated with Middle East instability are much diminished compared with earlier years, but remain a threat and an additional source of volatility in markets today. As for Brexit, both sides have moved some distance, which is positive, but all options, a deal, a further extension, a hard Brexit, remain on the table, and the situation continues to evolve very quickly and on a daily basis. Performance across the IPlus range came in just shy of 1% over the third quarter as markets oscillated, dipping in August and recouping lost ground in September. Year to date, performance has been pleasing, with returns of 4.5% in IPlus3, 6.5% in IPlus4, 8.5% in IPlus5, and 11.4% in IPlus6. Over the longer term, against their inflation plus targets, IPlus3, 4 and 5 are marginally behind but close to their targets, while IPlus6 has outperformed by over 1% per annum. We reduced equity in August valuations, while not overly rich on risk assets, but they did not fully reflect the risk of an economic slowdown plus other macro risks in our opinion. In lower risk strategies, we took equity down about 2.5%, up to 4.5% in higher target strategies. In fact, we put a little back in via topping up our global convertibles exposure, where we own this asset class, as we like, the convexity the asset class brings, where they become more defensive naturally should risk assets reprice lower. Where we saw better pricing was in dollar-denominated emerging market debt, short duration credit, high yield debt, and floating rate loans. So we added some exposure to these asset classes at the same time. We also added a little duration at this juncture, including a little to US tips and global inflation-linked bonds, preferring them to the more expensive UK income market. In terms of market data, it feels like we are at something of an inflection point, and the coming months will be key to pricing behaviour into year end and beyond. Central to all of this will be the policy response, which so far has been positive in that bouts of weakness in risk pricing have been balanced by more accommodative actions. To date, the weakness we are experiencing has been driven by trade and manufacturing, while the key service sector has remained reasonably firm. Employment has been strong and the consumer is generally in good shape. It's not a foregone conclusion that conditions will get worse from here. And in our view, and hence we are not outright bearish, but we are constantly looking at ways to build protection into the funds. Rates markets remain expensive today, with several additional cuts already priced in. But if we don't want to own bonds at these prices, then we need to have protection in the funds via other means. We do this by investing in real assets like property and infrastructure, and owning some gold and short duration credit. Corporate credit valuations remain at best fair, at worst expensive, so short duration remains our favoured way to take credit risk today. Emerging market debt remains attractive in our view, but we are not looking to take emerging market FX risk, and therefore we continue to own dollar-denominated debt. Infrastructure and property offer diversification and yield, and we favour an allocation to both of those today. We will be responsive to the incoming data, whether that's economic data or changes in market prices. Rapid market repricing should be viewed as an opportunity as much as it is a threat. By embedding diversification into our portfolios, it helps put us on the front foot to reposition our portfolios when the pricing moves too far away from the fundamentals.